You're told Wall Street professionals hold all the investment secrets. That's a myth. Imagine Peter Lynch, America's #1 money manager, during the 1987 market crash. Where was he? Not glued to a ticker tape. He was in Ireland kissing the Blarney Stone. This seemingly trivial detail reveals his core belief. The average investor, often called dumb money, holds an inherent, real-world edge. Fail to see this, and you'll miss opportunities others overlook. 1. Everyday discoveries, extraordinary returns. Welcome back to Audiobook Bites, where we distill powerful insights from the world's most transformative books. Today, we're diving into Peter Lynch's classic, One Up on Wall Street, and exploring the captivating idea of decoding the 10-bagger. Everyday discoveries, extraordinary returns. Now, what exactly is a 10-bagger? Imagine a stock that appreciates tenfold or more, turning $1,000 into $10,000 or $50,000 into $500,000. That's Peter Lynch's legendary 10-bagger. But here's the twist. These aren't found in obscure, jargon-filled high-tech ventures most people can't comprehend. No, Lynch insists, the most extraordinary returns often hide in plain sight, in the mundane, easy-to-understand companies we encounter in our daily lives. As he famously put it, average investors can become experts in their own field and can pick winning stocks as effectively as Wall Street professionals by doing just a little research. Think about it. Peter Lynch's own wife, Carolyn, was his ultimate market researcher. She wasn't scanning financial reports. She was shopping. One day, she came home talking about Legs pantyhose, noticing them in a freestanding metal rack right by the checkout at the grocery store. Women were buying them like crazy because they were convenient and less likely to run. The company behind it? Hanes. A simple consumer observation, yet this was a product with clear advantages, poised for national success. The beauty of Legs wasn't some complex scientific breakthrough. It was a better, more convenient way to buy pantyhose. But here's the magic. While Carolyn was noticing this everyday success, Wall Street analysts were completely oblivious. They were too busy chasing hot high-tech leads. The story was right there, unfolding in supermarkets across the country, long before it ever hit a brokerage firm's radar. The same applied to Dunkin' Donuts. You didn't need an MBA to see new franchises popping up everywhere. Always crowded, always busy. The smell of fresh coffee and pastries was a far more reliable indicator than any quarterly earnings call, signaling a business that was clearly thriving. You might be thinking, surely Wall Street eventually catches on? And yes, they do. But that's the amateur's true edge. By simply observing business developments and taking notice of your immediate world, from the mall to the workplace, you can discover potentially successful companies long before professional analysts do. This early jump on the experts is precisely what Lynch says produces 10-baggers, the stocks that appreciate tenfold or more and turn an average stock portfolio into a star performer. Professionals, burdened by rules, herd mentality, and the need to justify every move, often miss these grassroots opportunities until they're already well-established and significantly more expensive. Therefore, your daily life isn't just about errands. It's a treasure map. The local store with booming sales, the innovative product everyone's talking about, the restaurant chain expanding rapidly. These are your clues. Don't dismiss them as trivial. Instead, let your common knowledge guide your initial research. The bottom line, what you already know, what you see and experience every day, is your most powerful tool for finding extraordinary investment opportunities, if only you pay attention and dig a little deeper. If you want more insights into unlocking your investing potential and discovering your own 10-baggers, make sure to subscribe to Audiobook Bites so you don't miss our next deep dive into timeless financial wisdom. 2. Knowing your company's story. Peter Lynch, the legendary investor, offered us a powerful mental model, his 6 categories of stocks. This isn't just an academic exercise. It's a map to navigate the market, ensuring your expectations align with reality and saving you from some very costly mistakes. Think of it like this. Trying to invest without understanding which category a company falls into is like trying to drive a car blindfolded. First up, we have slow growers. These are the elder statesmen of the corporate world, large, established companies like today's electric utilities. They grow slightly faster than the overall economy, offer steady dividends, but don't expect explosive returns. As Lynch puts it, you won't find a lot of 2 to 4% growers in my portfolio, because if companies aren't going anywhere fast, neither will the price of their stocks. Next, the stalwarts. Think Coca-Cola, Bristol-Myers, Procter & Gamble. These are big, robust companies, growing at a respectable 10 to 12% annually. They offer good protection during economic downturns, a sort of safe harbor in a stormy market. But here's the catch. Once a stalwart has gone up 50% in a year or two, you need to ask yourself if it's time to take profits and look for the next opportunity. Then come Lynch's favorites, the fast growers. These are smaller, aggressive companies, often growing at 20 to 25% a year. This is the land of the 10-baggers, stocks that appreciate tenfold or more. Imagine discovering an early Walmart or Taco Bell. The trick is they don't have to be in a hot industry. They just need room to expand within their niche. However, they carry higher risk. If a fast grower falters, the stock can be brutally revalued downwards. As Lynch says, this jump on the experts is what produces 10-baggers, the stocks that appreciate tenfold or more and turn an average stock portfolio into a star performer. Fourth, the cyclicals. These are companies like autos, airlines, steel, and chemicals. Their sales and profits follow the economic cycle, booming in good times, crashing in bad. Buying them at the wrong point in the cycle is a fast track to losing half your investment. You might think, I'll just wait for the price to drop and then buy. But the danger is that getting caught at the peak, thinking the good times will last forever, means you're buying high. Therefore, understanding the early signs of recovery, like increasing inventories or firming prices, is crucial, allowing you to buy low and ride the upswing. Next, turnarounds. These are companies that have fallen on hard times. Think Chrysler in the early 80s or Penn Central after its bankruptcy. They're beaten down, often facing potential fatalities. But they have a plan for recovery, divesting unprofitable divisions, cutting costs, or introducing new products. This type of investment means their ups and downs are least related to the general market. Therefore, doing your homework on their debt structure and recovery plan is paramount, because it's the underlying business fundamentals that truly count. Finally, asset plays. These are companies sitting on valuable assets, real estate, oil reserves, patents, or even brand names that Wall Street has overlooked or undervalued. You're essentially buying something for less than its inherent worth. Think of a company with prime real estate carried on its books at ancient values. The challenge is identifying these hidden gems before the corporate raiders do. Why does this classification matter so much? Because knowing your company's story and its category dictates your strategy. You wouldn't expect a utility to deliver fast grower returns, just as you shouldn't sell a promising 10-bagger too soon like it's a stalwart with limited upside. Lynch reminds us, to my mind, the stock price is the least useful information you can track, and it's the most widely tracked. This insight alone prevents countless errors. You might be thinking, but the market is so complex, how can I possibly categorize everything? And you'd be right to feel that way if you tried to analyze every single company. But Lynch's point is simpler. Focus on what you understand. As he noted, my experience shows you don't have to be trendy to succeed as an investor. In fact, most great investors I know, Warren Buffett for starters, are technophobes. They don't own what they don't understand, and neither do I. This framework gives you the tools to understand what you own and why you own it. The bottom line, proper classification prevents mismatched expectations, guiding your investment strategy to align with a company's true nature and potential, not just fleeting market sentiment. 3. Why hot industries often lead to cold returns. It's easy to get swept up in the excitement of a hot new industry. The headlines scream about massive growth, new technologies, and instant millionaires. But Peter Lynch has a stern warning for investors who chase these trends. His experience shows you don't have to be trendy to succeed as an investor. In fact, most great investors he knows, including Warren Buffett, are technophobes. They don't own what they don't understand, and neither does he. Think back. In the 1950s, carpets were the rage. Every American housewife wanted wall-to-wall. Innovations made them cheaper, sales boomed, and the few major producers made huge money. Analysts naturally started proclaiming eternal growth. But here's the catch. This rapidly growing sector had no real proprietary protection. Therefore, when 200 new competitors rushed in, they immediately began slashing prices, and suddenly, nobody was making a dime. The carpet boom, once so promising, fizzled for investors. It's a pattern we've seen repeat countless times. Remember the disk drive industry? Experts predicted 52% annual growth. Yet, with 30 or 35 rival companies scrambling for a piece of the pie, there were no profits. Or oil services in the early 80s. Just saying oil on a prospectus was enough to attract buyers, but many of those stocks went from $50 to $1 because they were built on hype, not solid financials or protected niches. Mobile homes, digital watches, early biotech all fell prey to the same fate. This susceptibility to competition in hot industries leads us to another dangerous trap. Chasing the next something. The next IBM. The next McDonald's. The next Disney. People tout these companies as guaranteed winners, hoping to replicate past successes. But Peter Lynch cautions that, in his experience, the next of something almost never is. Often, proclaiming the next big thing marks the end of prosperity not just for the imitator, but even for the original it's trying to mimic. Circuit City became a successful electronics retailer, and then came a string of nexts like First Family, Good Guys, and Crazy Eddie, all of which lost most of their value. The next Toys R Us, Child World stumbled. The next Price Club, Warehouse Club, fared no better. Why? Because true innovation requires a protective moat. A patent, a niche, a brand name so strong it keeps competitors at bay. Without that, rapid growth attracts a horde of imitators, turning potential gold mines into profitless battlegrounds. Imagine waking up tomorrow to find your next big thing. Company is caught in a price war it can't win. Its innovative edge blunted by a dozen new rivals. The bottom line, if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. Don't be swayed by the sizzle of a hot industry or the promise of the next big thing. Focus on what you understand and seek out companies with sustainable, protected growth, even if their story seems boring to Wall Street. That's where the real 10-baggers hide. 4. Why the P/E ratio matters and how to use it. You see it everywhere in the financial pages. The P/E ratio or price-to-earnings multiple. Simply put, it's how many years of current earnings it would take to earn back your initial investment. On its face, a low P/E might seem like a bargain. But here's the catch. A P/E ratio alone tells you very little. Its true power emerges when you compare it to a company's growth rate. Peter Lynch taught us that for a fairly priced company, its P/E ratio should roughly equal its growth rate. So, a company growing at 15% per year with a P/E of 15? That's about right. But a company growing at 6% with a P/E of 12 is an unattractive prospect, likely headed for a come-down. You might be thinking, surely, a great company's stock will just keep going up regardless? But it gets worse. Even excellent businesses can become terrible investments if you overpay. Consider Avon or Polaroid. These were once household names, seemingly unstoppable. But in the early 1970s, their P/E ratios soared to unsustainable heights, 50, even 60 times earnings. Investors projected limitless growth, far beyond what the companies could realistically deliver. Therefore, even though the companies were still fundamentally strong, their stock prices plummeted dramatically, catching up to the underlying earnings reality. The market simply couldn't sustain those fantastical valuations. It's a common mistake to get fixated on the daily gyrations of a stock price. You check your portfolio, see a drop, and panic. You see a rise and feel validated. But as Peter Lynch warns, to my mind, the stock price is the least useful information you can track, and it's the most widely tracked. The price is a short-term popularity contest. Earnings are the long-term report card. Therefore, to pick winners, you must become an earnings detective. Ignore the noise. Imagine waking up tomorrow and ignoring every stock price movement, every market pundit, every fleeting trend. Instead, Focus solely on the company's real progress, its ability to increase earnings. In the long run, this is what matters. The bottom line, if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. 5. Uncovering cash, managing debt, and spotting hidden assets. In the world of investing, fancy stories and hot tips can be distracting. Peter Lynch teaches us to look past the superficial and dig into a company's true financial bedrock. He calls it the 2-minute drill, a simple, yet profoundly effective way to quickly gauge a company's financial health by focusing on its balance sheet. Imagine you're reviewing a company like Ford. Lynch's 2-minute drill means a quick glance at their cash position versus their long-term debt. When Ford's balance sheet showed billions in cash far exceeding its long-term debt, it revealed a financial fortress, not just an automaker. This isn't just about big numbers. It's about resilience. A company with a robust cash pile can weather storms, invest in the future, or even buy back its own shares, a powerful move that boosts shareholder value. As Lynch succinctly puts it, companies that have no debt can't go bankrupt. This simple truth is a cornerstone of smart investing. But here's the catch. A company drowning in short-term bank debt, even with seemingly promising products, is always a hair's breadth from disaster. Think of the electronics firm GCA, which faltered under a mountain of bank debt, while Applied Materials, in the same industry, survived its slump with a healthy cash position and less precarious funded debt. Therefore, understanding the type of debt is crucial. Funded debt, like corporate bonds with long maturities, offers a company time to recover, whereas bank debt can be called in at the first sign of trouble, leading straight to bankruptcy. Beyond the visible numbers, Lynch emphasizes the concept of hidden assets, intrinsic values often overlooked by Wall Street's analysts. Imagine owning shares in a company that seems modestly valued, only to discover it possesses vast tracts of real estate carried on its books at pre-Civil War prices, like the railroads or companies owning prime urban land. Or consider the power of patented drugs like SmithKline's Tagamet or Monsanto's NutraSweet, which grant exclusive revenue streams for years. Yet their intangible value isn't always fully reflected in the stock price. Even a growing base of cable subscribers, as with Telecommunications Incorporated, can be an overlooked goldmine. These assets provide a substantial safety net and enormous potential upside that the market often fails to appreciate until much later. You might be thinking, how can sophisticated Wall Street professionals miss these things? The answer often lies in their focus on trendy industries or their limited scope. The average person is exposed to interesting local companies and products years before the professionals. This everyday exposure gives you an edge to spot hidden assets and fundamental strengths long before the market wakes up. The bottom line, if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. 6. The promise of spin-offs and share buybacks. Peter Lynch understood that the true gems on Wall Street weren't always found in the flashiest, most talked-about trends. Often, they were hiding in plain sight, revealed by smart, shareholder-friendly management moves. Today, we're diving into two such strategies, spin-offs and share buybacks. First, let's talk about spin-offs. Imagine a large, perhaps struggling conglomerate with a few star divisions hidden within. Sometimes, management decides to unleash these divisions as independent public companies. Peter Lynch observed that spin-offs of divisions or parts of companies into separate, freestanding entities often result in astoundingly lucrative investments. This isn't just a corporate reshuffle. It's a strategic liberation. Think of Toys R Us, a retail giant that was once a division of the less successful interstate department stores. When it was spun off, it emerged with a clean slate, focused management, and a strong balance sheet. The parent company, wanting to avoid any embarrassing PR, ensured the new entity was well-equipped to thrive. The result? Toys R Us wasn't just a success. It became a 25-bagger for many early investors. This focused independence allows the new company to cut costs, innovate, and drive earnings without being tethered to the drag of its former parent. But there's another, perhaps even less glamorous corporate action that Lynch championed: the share buyback. This isn't about creating new products or expanding into new markets. It's about a company buying its own stock back from the open market. Peter Lynch famously declared, "Buying back shares is the simplest and best way a company can reward its investors." Here's the magic. When a company reduces the number of outstanding shares, even if its total profits remain constant, the earnings per share, EPS, automatically increase. It's a direct boost to shareholder value. Consider a company like Crown, Cork, and Seal, a mundane business making cans and bottle caps. Instead of blowing cash on risky acquisitions, they consistently bought back their own stock. This steady reduction in shares, year after year, compounded beautifully, creating immense value for shareholders. You might be thinking, why don't all companies do this? But often, management gets swayed by the allure of grander, more visible expansion projects. Therefore, a consistent buyback program is a powerful signal of management's unwavering commitment to its shareholders. These strategies demonstrate a profound wisdom. Value isn't always about what's new and exciting, but about what's disciplined and beneficial to ownership. These aren't trendy, high-tech plays. They are fundamental moves that signal a management team genuinely focused on enriching its investors. The bottom line, true wealth in the market is often built not on speculation, but on management's quiet, consistent actions that directly enhance the per-share value of the underlying business, creating silent 10-baggers for patient investors. 7. The 2-minute drill for every stock. Welcome back to Audiobook Bites, where we distill investment wisdom into actionable insights. Today, we're diving into Peter Lynch's revolutionary concept from One Up on Wall Street, the 2-minute drill, your ultimate tool for crafting a clear, simple investment story for every stock you consider. Lynch insists that before you buy a single share, you must be able to articulate the company's story so lucidly that even a child could understand it. This isn't about memorizing complex financial statements. It's about grasping the core essence of the business. The drill involves answering key questions. What does the company do? Why are you interested in it? What needs to happen for it to succeed? And crucially, what are the potential pitfalls or risks? This mental exercise forces thorough research and builds conviction. As Lynch himself put it, if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. It's about the fundamental value, not just the fleeting price. Think about La Quinta Motor Inns, a perfect example of a 15-bagger Lynch identified. His initial interest didn't come from a fancy Wall Street report. Instead, he heard a rival hotel executive express begrudging admiration for La Quinta's success. That was his lead. His 2-minute drill went something like this. La Quinta offered holiday and quality rooms, but at 30% lower prices. How? They cut out the costly extras like restaurants and conference rooms, often partnering with a Denny's next door. They focused on business travelers, building in convenient locations near corporate parks and hospitals, ensuring predictable clientele. He confirmed their business model by sleeping in their beds, tugging at their curtains, and checking their towels. They had a strong balance sheet, smart financing from insurance companies avoiding bank debt, and a repeatable formula they were rapidly cloning. This was a clear, solid narrative, verifiable through real-world observation and a little research. This keen observation and fundamental understanding is exactly what produces 10-baggers, the stocks that appreciate tenfold or more and turn an average stock portfolio into a star performer. He had a story he could trust. But Lynch wasn't infallible, and his failure with Bildner's, a gourmet food store, offers a powerful cautionary tale. He loved their sandwiches, ate there regularly, and saw their successful Boston locations. The company was going public, planning to expand into other cities. He was convinced this was the next Taco Bell. He bought in, relying on his local edge and enjoyment of the product. Here's the catch. He didn't properly complete his 2-minute drill. He overlooked crucial questions. Could this concept be successfully replicated in other markets? Did the company have the financial resources and managerial depth to handle rapid expansion into competitive environments like Manhattan, where established delis ruled? He was so caught up in the euphoria of a good idea that he failed to validate its scalability and financial resilience. But it gets worse. The expansion flopped, the company overextended, and the stock plummeted. His personal positive experience didn't translate into investment success without the necessary due diligence on the business model's replicability. The crucial takeaway from these contrasting examples is the power of the simple, verifiable story. It's not enough to like a company's product. You need to understand its economic engine and its capacity for sustained, profitable growth. The bottom line, never invest in any company before you've done the homework on the company's earnings prospects, financial condition, competitive position, plans for expansion, and so forth. 8. Cultivating the psychological traits of a successful investor. Beyond spreadsheets and balance sheets, Peter Lynch reveals a more profound truth about investing. The ultimate battle is waged not on Wall Street, but within your own mind. To succeed, you need a psychological edge, a set of traits more valuable than any hot tip. Picture yourself at a lively cocktail party. In the early stages of a bull market, when stocks are quietly gaining, nobody wants to talk about them. You mention you manage a fund, and people nod politely, eager to discuss sports or the weather. Asterisk, but here's the fascinating shift asterisk. As the market climbs higher and higher, the crowd around you grows. Soon, everyone is eagerly sharing their latest stock tips. Even the dentist has 3 or 4 can't-miss ideas. This is the precise moment Lynch warns you about. Investor sentiment reverses at the absolute worst time. People turn wildly optimistic at market tops and plunge into despair at bottoms. The true contrarian, Lynch points out, does the opposite. As he says, the true contrarian waits for things to cool down and buys stocks that nobody cares about, and especially those that make Wall Street yawn. You might be thinking, surely smart investors can predict these market swings? But the wisdom of Lynch, honed over decades, tells us otherwise. He observed the 1987 crash coming no more than anyone else. Despite complex models and endless data, market prognosticators consistently fail. But, therefore, entrusting your investment decisions to fleeting gut feelings or the ever-present chorus of economic forecasts is not only unhelpful, it's downright dangerous. Therefore, your unwavering conviction must spring from a deep understanding of a company's fundamental story, not the market's unpredictable whims. As Lynch states, predicting the short-term direction of the stock market is futile. This brings us to perhaps the most crucial psychological trait, profound detachment from daily price movements. The stock price itself, Lynch stresses, is a master of distraction, a relentless siren song designed to lure you off course. Imagine a constant ticker tape flashing on your screen, screaming new numbers every second. Asterisk, here's the stark reality asterisk to my mind. The stock price is the least useful information you can track, and it's the most widely tracked. It offers no insight into a company's true intrinsic value, only a fleeting snapshot of what someone else is willing to pay. A stock's ascent doesn't automatically validate your thesis, nor does a decline instantly negate it. What truly underpins long-term success is the company's evolving narrative, its earnings power, its robust assets, its sustainable ability to grow. As Lynch sagely advises, if you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. This calls for patience, the remarkable ability to snore through short-term fluctuations, to remain steadfast even when your investment appears dormant. This quiet confidence, this self-reliance to ignore the prevalent noise and implicitly trust your diligent homework, is the hallmark of every truly successful investor. The bottom line, true investing success isn't about predicting the market. It's about mastering your own mind. If you want to develop the psychological fortitude and practical skills to find your own 10-baggers and transform your portfolio into a star performer, then subscribe to Audiobook Bites and join us as we continue to unlock the timeless wisdom of one-up on Wall Street. 9. Active portfolio management and selling discipline. Many investors dream of finding that perfect stock, buying it, and forgetting about it for 20 years only to return to a fortune. Sounds idyllic, right? But Peter Lynch, the legendary manager of the Magellan Fund, would tell you that true investing is rarely a set-it-and-forget-it endeavor. It's more like tending a garden where vigilance and discipline are rewarded. Lynch firmly believed in the power of continuous monitoring. Every few months, you need to recheck the company's story, dig into its latest fundamentals. Are the earnings still holding up as expected? Is the competitive landscape changing? These aren't just academic exercises. They are vital checkups on your investment health. This brings us to a crucial distinction in active portfolio management: watering the flowers and cutting the weeds. For stalwarts, those large, established companies like a Coca-Cola or a Procter & Gamble, your strategy should be about judicious rotation. If you've achieved a solid 30 to 50% gain, and nothing spectacular has happened to accelerate their growth, Lynch would suggest it might be time to take those profits. But here's the catch: you don't just sell and walk away. Therefore, you reinvest that capital into another undervalued stalwart, another dependable company poised for its own modest climb. Fast growers, on the other hand, are your potential 10-baggers. These are the flowers you want to water, not pull out prematurely. As long as the company's earnings are growing, its expansion continues, and no fundamental impediments have emerged, you hold on tight. Lynch saw many investors make the fatal error of selling their best performers too early, while stubbornly clinging to underperforming stocks with deteriorating stories. You might be thinking, what about protecting against losses with stop orders? Peter Lynch was vehemently against them. A stop order, for the uninitiated, automatically sells your stock if it drops to a predetermined price, usually around 10% below your purchase. It sounds like a safety net, but it often turns into a self-fulfilling prophecy. The market's daily gyrations can easily trigger these stops, forcing you to sell good companies at precisely the wrong moment. Therefore, instead of relying on arbitrary price triggers, focus on the fundamental story. As Lynch wisely noted, to my mind, the stock price is the least useful information you can track, and it's the most widely tracked. Don't let short-term price fluctuations dictate long-term decisions. Emotional selling is the enemy of long-term wealth. When a stock you own drops, it's natural to feel panic, but this is exactly when you need conviction. If the company's story, its earnings, its balance sheet, its market position, is still intact, a price drop can be a buying opportunity, not a signal to flee. Imagine waking up tomorrow having sold a promising company only to see its fundamentals rebound and its stock price soar, because you let market noise override your research. It happens more often than you'd think. The bottom line: investing is an ongoing conversation with your companies. It demands attention, discipline, and a willingness to constantly reevaluate, allowing your winners to run and your underperformers to be replaced. Don't fall prey to the emotional roller coaster of market prices. Let the company's real-world story guide your actions. 10. The enduring wisdom of the individual investor. Peter Lynch's enduring wisdom lights the path for the individual investor. He argues that average investors are uniquely positioned to outperform Wall Street's professionals. How? By simply leveraging common knowledge and doing a little research into the businesses you encounter every day. Think about it. The opportunities for 10-baggers, stocks that appreciate tenfold or more, often appear right under your nose. They are found in the products you buy, the stores you visit, or the services you use, long before the financial experts take notice. Lynch emphasizes that average investors can become experts in their own field and can pick winning stocks as effectively as Wall Street professionals by doing just a little research. The secret isn't in complex algorithms or insider tips, but in understanding the underlying business. This means shifting your focus. To my mind, the stock price is the least useful information you can track, and it's the most widely tracked. If you can follow only one bit of data, follow the earnings, assuming the company in question has earnings. The market's short-term gyrations are mere distractions. Long-term success hinges on a deep understanding of the business's categories. Is it a slow grower, a stalwart, a fast grower, a cyclical and asset play, or a turnaround? Each requires a different approach, and knowing the story behind your stock is paramount. Here's the catch. This strategy is not for everyone. It's certainly not for those needing their capital in the next 2 to 3 years. Stocks can fluctuate wildly in the short term. It's also not for investors lacking patience, self-reliance, or detachment, the ones who panic during market drops or chase hot tips without doing their homework. But, therefore, ***, many assume investing is about market timing, But Lynch reveals this is a fool's errand. Therefore, focus on what you can control, thoroughly researching a business and holding it as long as its fundamental story remains strong. Imagine waking up tomorrow, no longer swayed by market noise, but confident that your investments are rooted in solid businesses you truly understand. This is the power of Peter Lynch's approach. The bottom line: your financial destiny isn't whispered in boardrooms, but forged through diligent research and patient conviction in businesses you truly understand.